Hey everyone, welcome back to Corporate Decoder. Today, we're diving into the latest annual report from Markforged, a 3D printing company. Get ready for a roller coaster because this report has more twists than a 3D printed roller coaster. We're going to break down their struggles of potential merger and whether they can actually stay in business. Markforged makes 3D printers and the materials to go in them. Think of it like a regular printer, but instead of paper and ink, it's plastic, metal, and carbon fiber. They sell these printers to businesses that need to make parts for everything from cars to airplanes. This is their annual report, a Form 10-K filed with the Securities and Exchange Commission. It's a deep dive into how the company performed over the last year, what challenges they face, and what their plans are. This report is for the fiscal year ending December 31, 2024. First, the report indicates that based on the closing price on the New York Stock Exchange, the total value of Markforged stock held by regular investors was only around $54.1 million as of June 30, 2024. This is a small number for a publicly traded company and is important for later discussions around their stock value and potential delisting. Let's start with the not so good news. Markforged lists a whole bunch of risk factors that could impact their business. These are the things that the company thinks could go wrong, from a failed merger to ongoing payment problems. A big one is their proposed merger with Nano Dimension Limited. They say that if they can't complete this merger or if it takes too long, it could hurt their business and the stock price. They've also been dealing with lawsuits, including one where they have to make substantial ongoing settlement payments. This is a fancy way of saying they lost a court case and now have to pay a lot of money over the next few years. Here's the real kicker. The report says there's substantial doubt about Markforged's ability to continue as a going concern. This means there's a real risk they might not have enough money to stay in business. They point to a history of losses, negative cash flow, and these ongoing payment obligations as reasons for this doubt. It's never good when a company openly questions if it can continue to operate. Let's get to the numbers. In 2024, they lost $85.6 million. That's a lot of money to lose in a year. The previous year wasn't much better, with a loss of $103.6 million. Also, their revenue is down. In 2024, they made $85.1 million compared to $93.80 million the year before. So they are losing more money while bringing in less. They also depend on selling to the government. If they lose government contracts or if the government changes its spending, it could really hurt their business. And here's another red flag: they might get kicked off the New York Stock Exchange. The price of their stock has been so low that they risk being delisted, which would make it harder for people to invest in the company. Basically, this company has a lot of risks, as they themselves are clearly stating. It's unusual to have a summary as dire as this in SEC filings. So what's the plan to turn things around? It boils down to four things. First, they want to focus on software. They believe that by making their software better, they can get customers to print more parts, which will generate more data and make their software even smarter. They want to focus on their software subscription. Second, they plan to expand what their printers can do. This means making bigger, faster, and more precise printers and adding new materials. They want to solve more problems for their customers so they can sell more stuff. Third, they want to improve their sales and distribution. They plan to grow their global distribution and optimize their sales model. It's a bit vague, but it means they want to sell more efficiently. Finally, they want to build a stronger brand. They think that by investing in their brand, they can attract more customers and lower their costs. They say they have a unique and modern software platform that gives them opportunities with AI and integrations with different part inventories. All great stuff. Let's quickly jump to the actual numbers. Here's a quick look at the income statement. Revenue decreased 9%, $85 million compared to $93.83 revenue, especially when you're trying to turn the ship around. Cost of revenue also decreased 11%, $44 million versus $49.4 million. The reason for the large cost of revenue decline is that it is simply tied to lower revenues. Gross profit, which is revenue less cost of revenue, came in at $41 million versus $44.4 million, which means that their profits are down as well. A quick note that they are a non-accelerated filler, smaller reporting company, and emerging growth company. This means that they are not subject to some of the same rules as big companies, which can mean they have a bit more wiggle room in how they do things. They are listed on the New York Stock Exchange under the ticker symbol MKFG, and mentions a previous notification that the company had fallen out of compliance with the NYSE's minimum bid price listing requirement, but as of this report, they've regained compliance. Here's a problem. The company admits that their internal controls over financial reporting aren't great. They say they have identified material weaknesses which may result in material misstatements of the financial statements. In simpler terms, they don't have a good handle on their finances and could be misreporting things. They may not be able to use all of their net operating loss carry forwards, which are like tax credits from previous losses. It means the company might not be able to save as much money on taxes in the future as they hoped. This is a bit technical, but it's not something you want to see. Like other global companies, they are subject to anti-corruption laws. They have risk management processes and also have processes to inform and update management, but risks from cybersecurity threats have not materially affected them so far, and they don't expect them to anytime soon, thankfully. Alright, before giving a final verdict, let's check that none of these sections have anything worth mentioning. This section just says that some parts of their proxy statement, basically a document for shareholders, are included in this report. This lists all the documents attached to the report, mostly legal agreements and contracts. Nothing too exciting here, so what's the final word on Markforged? They're in a tough spot. On one hand, they're trying to innovate in a growing industry. On the other hand, they're losing money, facing lawsuits, struggling to maintain their stock price, and have internal control problems and are even unsure if they can stay in business. The Nano Dimension merger is a gamble. If it goes through, it could give them the resources they need to turn things around, but if it falls apart, they will need to quickly figure out what to do. Markforged needs to make some serious changes if it wants to survive. They have the right idea on how to fix the company, but a lot of these initiatives are long-term goals. It's not a good look to tell your investors to hold on for 10 more years, so they might need to pivot into some new plan. Thanks for watching. If you found this video informative, hit that like button, leave a comment, and subscribe for more corporate deep dives. See you in the next one.